Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have an amazing guest in Mr. Jason Janda from Rochester Property Group. Before we dive in, I want to ask you a real quick favor. Would you mind please taking an extra 30 seconds and heading over to iTunes to rate this podcast with 5 stars? This helps us get more listeners, and it means the absolute world to me. So thanks for making my day with that 5-star review of the show. All right, let's dive in. Jason Janda, the CEO of Rochester Property Group, is a real estate tax attorney and mobile home park operator. After working in various legal and business capacities, both in private equity and within law firms, Jason decided to create his own firm to acquire and operate mobile home parks throughout the Midwest. Jason currently operates 15 communities across 6 states. Jason, we are excited to welcome you to the show.
Thanks for having me. Big fan.
Awesome, man. Let's start out by just learning about your story and how in the world you got into manufactured housing.
Well, I think you touched on a lot of it. My background was as a real estate and tax attorney, similar to some of your listening base. I started out in the apartment world, real estate private equity. We would do syndications on the apartment side. I transitioned from in-house counsel to director of acquisition, so I got a good understanding of the underwriting and what type of apartments to buy. Fast forward, the Great Recession happens. The company I was working for stopped buying during that time. So bounced to a different real estate private equity firm and then eventually to a law firm. At the law firm, I was the low man on the totem pole. And so I was the guy doing borrowers' opinions for all the Fannie and Freddie mobile home parks. So just dumb luck, I got to see the underwriting, and just on a pure real estate finance basis, the returns that these mobile home parks were generating far exceeded the cap rates that we used to buy apartment buildings at. But the debt from Fannie and Freddie was almost the same. So that means your spread was huge. Now, granted, things have changed over the last, call it 12 to 15 years, but that was really the nexus of, getting interested in the space.
Wow, that is fantastic. So take us back before the Great Recession. You were in acquisitions at an apartment syndication group, right?
During it. So during
it.
the Great Recession, at the time, we had bought a couple of DPOs, discounted payoffs on notes to buy it directly, because a lot of the banks at the time, they didn't want to hold the actual asset because they didn't want the liability. So, it was a much different environment. But so they would, if your property was underwater, they would appoint a conservator and hire a third-party management company, but they still wanted the borrower to own the property just in case that slip and fall happened.
Wow.
And so it was just such a different world. But at that time, lending was very tight. And so we weren't doing a lot of additional acquisitions. And, when your compensation is tied to doing acquisitions, that's not the best situation.
Oh, totally.
For an individual.
Did you take anything away from that time, that you implement in your business today, right? Like you said, one of my great mentors, he always talks about how liquidity just dried up. And he's always like, when we first started buying parks, he was always like, hey, you need to do certain things with the debt you're taking to protect yourself. So I'm just curious, Jason, if you have, similar things in your business, rules of thumb, if you will, that you implement from your time, doing acquisitions in the middle of the Great Recession.
I would say yes. And I would say more big picture. One, just understanding that this is all going to be cyclical. Right? Over the next 20 years, we're going to have another up cycle. We'll probably have another down cycle. Right now we're kind of getting pinched with interest rates being high, but lack of inventory. So prices are still relatively high. So it's just harder to make stuff pencil. But during 2020, 2021, fortunately, we weren't buying the 4 cap, 4.5 cap stuff, because even if we could lock in that low rate for 5 years, unless you're getting Fannie or Freddie paper and you're locking it in for 10 plus, it's scary because, historical rates are closer to 6. Look at where we're at now. The 5-year, which a lot of our debt is based on, is up. But in addition to that, regional banks have felt the squeeze. So they've expanded their own spread over the 5 year. So you're kind of getting the double whammy. So it's just trying to remember, hey, look, right around under 6% debt, we're basically happy with it. Try to focus on good long-term investments at reasonable prices. And if there's an upside, trying to execute that upside definitely before any sort of debt is coming due.
Totally. Tell me about variable rate loans. Do you do anything like that, or any bridge debt on your acquisitions? Because I know that a lot of my apartment friends, they've been in trouble recently with some of that stuff, but some of them haven't.
Oh, definitely. And same with mine. I have a lot of friends that did, debt yield, a debt fund execution, right? That's what got certain things closed. But when it's variable and when, you know, your your baseline is 1% or less, and your spread is, call it a point and a half, 2 points above that, it's fine. Now when it's 9, good luck, right?
Yeah.
So fortunately, we typically try to do at least 5 year debt. We start out, I'd say, a little more aggressive on what our LTV is than what some shops would. But that's because most of the stuff we're buying has some sort of value add component. Either it's a physical value add, or rents have been below market for an extended period of time. So if we're buying it at 70-75% LTV, within 2 to 3 years, if we execute our plan, it's closer to 50 to 55% LTV.
I love it. It seems like you have a very similar business model to our own,
Yeah.
which is, buying in the Midwest and buying value add, from mom and pops and fixing them up, increasing the income. And that's why we're still able to get deals done right now. I've talked to some groups that they haven't bought anything all year. And I'm like, hey, well, we've done 5 deals this year, which we feel pretty confident in. And it's all value add stuff that, the going in cap rate doesn't look great. And it's a little bit harder, right, to get financing on the going in income that the mom and pops have stated. But year 2, year 3, when you look at what we're doing with it, that's where we're able to sell them on the business plan. Is it similar for you in the marketplace?
Definitely. We're seeing the same thing. We're seeing banks tighten their lending standards.
Yeah.
Before pro forma was acceptable, now it's, hey, show us what's actual.
Yeah.
Yeah. But we're also seeing a rise in some seller carry, which helps.
Mm-hmm.
Not long-term seller carry, but you might get 3 years or so.
Yep.
And if that gets us through this rough patch, and if the Fed lowers rates a little bit over the next 2 to 3 years, that might be the bridge you need. But
Yep.
similar to yourself, look, if you buy it, we're finding supply of new homes and used homes is increasing at a more reasonable cost on a more reasonable timeline. So we can fill up some properties, some communities faster. And so the execution is there. The problem is just the inventory is not there, right? So we're pounding on a lot more doors, a lot more cold calling, all of that sort of stuff.
Totally. Jason, what do you think is the toughest hurdle to overcome in mobile home park investing?
Oh gosh. Sure, there's a lot. I'd say from the passive side, it's just getting comfortable with the actual operations, right? And understanding the difference between a park-owned home versus a tenant-owned home versus, okay, hey, this is the underlying property we're investing in, and understanding the potential pitfalls, I guess, would be the best way. So coming to mind is like a wastewater treatment plant. You buy a small park with a wastewater treatment plant, that can be very expensive to redo. And so if the community is not 7,500 spaces, probably want to avoid that, and there are definitely exceptions to that, but just becoming knowledgeable about what you're putting your money in, I would say is it's a learning curve.
Totally. To piggyback on that, what are the type of communities that you're targeting, currently with your portfolio? Like, is it majority tenant-owned homes, or do you like park-owned homes? Or will you buy with private utilities? Maybe just give us some color if you don't mind.
Definitely. We're value guys, right? We're a value shop. So unfortunately, it's in all of the above. It depends. If we have to take a lot of park-owned homes, there has to be value for us. And you might fix those up. You might sell those off. You might do somewhat of trade. And this is a little counterintuitive. Someone's paying $650 rent, home and lot rent. you might sell them the home cheaper, but bump the lot rent a little bit and lower their overall payment. They're happy with that, but you've just capitalized that increase in lot rent. And so I'd say, but to answer your question, well water we're fine with. Strongly prefer public utilities. You know, the best would be direct build all utilities. You can't always find that. Tenant owned homes are easier, right? Because even the park owned homes you have, someone's going to move out. You're going to have a downtime. It depends how quick you've got a rehab crew around there that can bring it back and then rent it out again. And unless you're in certain markets, you just have to think, is this something I really want to deal with versus selling the home off and have it 100% tenant owned homes. And then at that point, you have a much more stable property and you have fewer move outs and move ins.
Totally agree. Tell me about your operations. Do you guys use a third party manager? Do you manage in house? How's that set up?
We have an affiliate, which is a property management company called MH Communities. We manage in house. When I started, like a lot of people, did the management all myself.
Mhm.
And the problem with that is, as I'm sure you can appreciate, that's just not the best use of time, right? There's a better use of time in focusing on acquisitions, investor relations, focusing on the financing, the day-to-day property management of tenant complaints, especially park on home issues. That's just not the best use of time. But what I have realized is if you're not buying the largest properties, then doing it in-house makes a lot of sense. If you're buying properties that are big enough, you can farm it out to a third-party property management company. But if you're buying a 50-space park, they might have a de minimis monthly fee, and that might be a large percentage of your overall rent.
Yeah, totally agree. And even then, right? Like we've bought, I think, 3 properties this year that were third party managed by, I won't say who, but it's a big nationwide management company. And they're running on like 55 to 60% expense ratios. And I mean, our entire portfolio is under 35% expense ratio. So it's just, they're just less efficient, right? Compared to in-house, where you're just, you care, you're vested, right? You want that property to succeed. So that's interesting. So you're hands-on, you have your own operations, affiliate company, and you're managing the projects and things in-house as well with that, right?
Definitely. And the other thing that you can do if you're managing it in-house is we try to leverage technology and whatever platforms we can use as early as possible, just to streamline, right? If we can take man or woman hours out of the equation by automating and paying a fee for that, it usually makes sense.
Totally. No, totally agree. What's the average lot number size of your communities?
We target the 50 to 90 range.
50 to 90
like
range?
That's big enough where, it makes sense. We can get decent financing. But as you know, once you get over 100, 150, there's so many competitors that what's the cap rate you're able to buy that at? If you got an amazing acquisitions team and you pick it off, great. But can you consistently find the big ones that haven't been touched by everyone?
Sure. The bigger groups. Totally. And you were in acquisitions for the apartment deals. So I'm taking it you do it acquisitions now. How do you guys find your deals?
It's an all of the above approach, right? Everything from cold calling, direct emailing, direct mailing, paying finder's fees when possible. Because typically the fully brokered package, we're not winning those. There's people with cheaper capital elsewhere.
Mm-hmm.
And even if it's not cheaper capital, they have a shorter horizon, so they can probably hit their IRR return. Whereas, we view ourselves more as stewards of capital. We're in it for the long term. Our goal is to provide consistent long-term returns quarter after quarter.
Wonderful. Wonderful. I'm assuming, the best opportunity or strategy that you're seeing right now is in value add deals, Midwest. Do you have any other color that you can add on like where you think the best mobile home park investing strategy is right now?
I see a lot of opportunities developing in the South. So when, call it 6-7 years ago, not a lot of people were buying in Alabama, Louisiana, but the returns there are similar to what I saw in the Midwest when we started in the Midwest.
I feel very strongly different. I feel strongly against that. And let me tell you why. because we've explored some markets. And now if you're in a big market, right, in
Yeah.
Alabama, in Mississippi, that's like, the capital or something like that, it's hard to go wrong. But in any sort of like secondary, tertiary markets around there, I've just seen just a low quality of tenant, ultimately, like very
Yeah.
low income, like the very, if you look at the best places, like the low median income. And then also one thing that I picked up on that, it just is an anomaly or something. But if you look, I'm on a repo list where all the mobile homes in the country, I get like a list of all of them. And every single month when I get that email of the list of mobile homes that are being repoed, it's like Mississippi and Alabama are like the number 1 and number 2 states where all those homes are getting repoed. And it's like, I would hate to get into that type of a market where it's like, geez, you're trying to increase rents, to be able to maintain the property. And what if you're just not able to because it's just such a low income area? So I'm sure
Definitely.
there's nice pockets, but that's been my experience.
No, and that makes a ton of sense too, because if you're dealing with a tenant base that only has so much income, and if they're buying, call it home X, which is financed by company Y, you know what those interest rates are. They're relatively high. So the
Super high.
the slightest change in that person's lifestyle, right? Their car might break down. They might lose a job, what have you. They're losing the home. But I guess let me just clarify why I'm saying the South. What I've seen in the South has been operators who haven't touched rents in a very long time. We're still based on really low monthly income. Rent can go up by a large percentage base. Now, granted, again, it's sector specific, market specific. So if you're in tertiary Alabama, don't think it's going to work, right? But
Totally.
But if you're in a better location in Louisiana and guy X has been operating it forever and the rent is 175 still, because that's how it's always been, right? And the market dictates that, could go up not quite double, but close to it. We're not the type of shop that does that comes in and just, underwrites it like that, comes in, doubles it day one, but we'll make those improvements and slowly walk the rent up to market. And
what does that look like? What is slow? Like, how much are you comfortable with in a given year? If market is double, the 170.
It really depends on the underlying customer base, and it depends what the overall dollar amount is, right? So if you're buying $200 rents, that percentage jump might be higher than if you're buying $400 rents in a market where market rent is $650. And so it's hard to pin that down. Might be 10%, might be 15%. But usually that's after coming in. One of the main things we see a lot, I'm sure you do too.
So 10 or 15%. If you got a market that's 400 lot rent and current rents are 200, you're only going to go 10 or 15% year one on increase.
Oh no, I was talking more of a $400 lot rent going up 10 or 15%. So that's $40 to $60 because that's where it starts to have a meaningful impact on the underlying customer base.
Gotcha.
Right, your tenant base.
But if it's 200 going to 400 market, what's a fair year one number?
You're doing that faster. I can't think of the last one we did, but again, we do it slowly. The reason we do it slowly is that's going to be a 20-year hold for us, right?
Sure.
And so our partner base knows that, and we're underwriting that, and we're slowly getting there. And then the other thing that's happening is you are going to have some turnover. Those new tenants are coming in at market.
Sure.
Right.
Yeah, totally. With the infill homes and everything. Yeah, they're coming in at
But
market.
what we're also trying to do, because it's a balancing act, you also don't want to increase it enough that someone says, oh, you know what? I'm taking my home out of here.
Sure.
Right. Because the value that you lost on that versus the value you've increased in the capitalized lot rent, you want to make sure they work together.
Totally.
But I guess
and I think
to answer your question, it's getting harder.
Yeah, I think with a good amount of CapEx that's been dumped into a property, new roads and taking care of the deferred maintenance from the mom and pops, trimming the trees, fixing the cracks in the sidewalks, things like that, new mailboxes. I totally think that, a $50 to $75 increase in year one is warranted. But you gotta, you just gotta do the work. And that's where a lot of other operators have not done the work, and they just come in and jack up rents $200 in year one, and they give everybody a black eye. So
And they
it's kind
give
of
us all
crazy.
those phone calls, right? All those
Exactly.
tenants start calling, hey, can I move in yours?
Exactly. Yeah. Jason, what mistakes in mobile home park investing have you made that our listener base can learn from, and I can learn from?
Okay. Well, early on, I can still tell you, before I even did my first transaction, was paying some of the out-of-pocket due diligence before finishing the standard due diligence that we request in the, whether you call it Dropbox box, however it's getting sent to you. But I still remember the first one. We signed up a phase one, we got a survey, all this money was going out the front door. And then lo and behold, we realized we get everything back. We didn't get the bank statements. We finally get the bank statements. And this particular operator wasn't collecting the rent he was. And so he only gave us the last 3 months because he was doing deposits of his own money
Man.
into the bank. By this point, I'm out, 5 or 6 grand, right?
Mm,
I've got all these materials on a park I'm never gonna be able to close. I
that's
brought it to
tough.
this,
That's tough, man. How did you get educated on mobile home park investing?
you know, I don't think a lot of us started thinking,
Mhm.
hey, let's stay in the MH space, right? Like
Sure.
that's a great space for us. It was a transition from apartments. So I had a decent knowledge and decent training
Underwriting and that kind of side of it, right?
and from there, it's just the jump of, okay, what's the main difference? So if you've got a mobile home park that's all park on homes, very similar to an apartment building.
Hmm.
You have one that's all tenant on homes, it's much easier to operate than an apartment building.
Totally.
And then, just getting that,
But did
the
you go
other,
to like the MHU boot camp, the Franken Day boot camp, or
oh,
anything like
yeah,
that?
about a decade ago.
Okay. So yeah,
Yeah.
I think like most operators that I've had on the show have gone to that and kind of cut their teeth and kind of learn from that. And
Yeah.
and I was telling someone the other day that like, when that thing came out, they give you the 30-day due diligence handbook and there's like 50 checklist items. And I was going through our due diligence on a new deal, and it's like 350 checkpoints now. Like we've
Yeah.
learned stuff from every deal, and made because we made mistakes, right? From X, Y, and Z, you name it. We've learned from it, but it's a good boilerplate kind of seminar, right? Weekend boot camp to go kind of cut your teeth.
Definitely, definitely. I've actually reached out to Brandon to see if they still do it. I think they're just starting it back up. I think at Frank's house. But you also go through it. And back in 2013, it said, okay, you have to buy it if it's a 10 cap. You can't buy anything less than that. So that's how
Yeah,
I started. I
totally.
said, okay, I'll buy all the 9 cap stuff, right? Because I can go,
Happily.
even back then, I could go get 5.5, 6% debt.
Sure.
And
Yeah.
so, your cash on cash was huge.
Yeah. Any other mistakes that kind of come to mind that you think we can share with the listeners?
I can tell you one that I can think of is letting the tax tail wag the dog. There, obviously, accelerated depreciation is a big thing in our industry. And so having that accelerated depreciation and coming up with that as the excuse for buying a certain property that might be just on the edge, I can tell you that was one of the ones where if you look back, we probably shouldn't have bought it. We may do, but just like whether it's your kid or whatever, one kind of more difficult project or problem took up maybe 35% of our time, right?
Yeah.
So you had one, call it 50 space park, and that was a third of everyone's day. That's
Yeah.
just not worth it.
And that's the same thing. An investor asked me, "Oh, why aren't you doing development? Ground up development of mobile home communities?" I said, "Well, there's lower hanging fruit right now in the marketplace that is easier to scale with compared to like learning something from scratch that I've never done before. I'm sure there's opportunity in certain markets to build ground up, but the time and effort that would go into that versus what we already know is just a better use of time. Do you
Oh,
agree?"
definitely. I'm sure you've got a bunch of other people on the podcast. I've heard some as well that dive into RVs. That's just still
Mhm.
just another thing that, I still see enough opportunity in the MH space, at least in the niche that we operate,
Yeah.
that I'd rather, continue to do what we know very well rather than to start learning something else.
Totally. So have you guys done any deals this year, Jason, in 2023?
Yeah. We do a couple every year. We have a very tight sieve. So we start with a big funnel and then not a whole lot gets through it. But, we've got another one closing on the 31st of this year. we pick off, it's kind of
Tell
a
us
hub.
about them. The deals you've
Okay,
done,
so
the
it's like a hub and
size.
spoke model. So if it's a bigger property, we will take a stab at it almost in any of the 12 states in which we target.
Mhm.
But if it's a smaller property, we'll still take a stab at it if it's close to another one, especially if we've got a good manager there,
Totally.
right? So we can bolt on. Because what we've come to notice is if we've got about 300 sites within about a couple hours radius, then we can operate those very well. Then we can support a maintenance crew that can rehab homes. We can float people. We can borrow different trades, right? So if I've got a great electrician here, I can send them over here, plumber, etc. That's definitely the model of growing out in a certain state. But if it's a new state and it's a 35 space park, it's probably not going
to scale. Yeah. Do you guys do one-off syndications, or do you have like a fund that you raise money through?
So we typically do one-off syndications. Again, my background came from the apartment space, so I try to gear it in the way most optimal to raise money. And so that turned into low fees, higher back end promote, alignment of interest, and then being very transparent on quarterly reports, right? Here's what gross income was, here's operating expenses, here's our NOI, here's debt service, here's cash flow. And based upon those, this is how much we can distribute. So then that was one of my frustrations as an LP. I'm an LP in about a dozen apartment syndications. And a lot of times it's a black box where you're getting a certain distribution. You don't know how it's based. You don't know why you're getting
You're
it
lucky.
or what date.
Yeah, you're lucky if you're getting apartment distributions right now. I mean, I've heard horror stories.
Oh, definitely. Especially, state specific. We do operate in Illinois right now. We will not be operating in Illinois in the future, but there's certain states that make it very hard to operate. And so learning that's another big mistake.
New York is a big one. Yeah, we made a mistake and bought one there. And, the judge, we go and meet him every 90 days to try to evict the same tenant that hasn't paid since we bought the park. And he just keeps extending because they have kids and it's a family. He doesn't want to kick them out on the street. So he just keeps extending. And it's been over a year now that we're not able to evict this one tenant that literally wasn't paying the previous owner. So,
oh my gosh.
It's
we
crazy.
had it spread at an Illinois park. So you'll appreciate this. 61 sites. And we had over 100,000 in delinquency.
Oh my goodness. Wow.
It spread like wildfire because a couple people realized, hey, you don't have to pay rent. They can't kick you out.
Jeez.
And so the longest person we had, I think, was 26 months.
Oh my goodness.
26 months without paying rent. We couldn't evict them because there's an eviction moratorium. And then even when that was done, there was such a backlog at the courts. And then even when you finally got your court date, the judge was basically telling you, hey, go negotiate something. I don't want to do this eviction.
It's so wild. And I will say, until it ran out, the rental relief programs in Illinois, because we own properties in Illinois, and the one in New York, until the money ran out, they were writing big checks. They were like, hey, we'll cover the whole last year, and would send us in $10,000, $11,000 checks to cover, the past due balances for several tenants. So we went down that road. But when the money ran out, it was like, hey, there's nothing left because they can only go back to that program so many times. I think it's like once or twice, and they're just dead.
Yeah. And that was a mistake we made in Missouri. We bought a property during the pandemic. We liked it. Price was right, everything else. But a lot of people were paying through government assistance, the rental checks. And so you couldn't really gauge, and we were fine. We were getting a lot of money. But then when it stopped, a lot of the rent stopped.
Yeah. Oh, man.
And so then you had so many evictions, and then you're rehabbing homes, and then literally you're taking out a new loan just to, fix the property rather than do anything else.
That's crazy. Jason, what do you think are the most important things that passive investors, we're talking LPs, need to look out for when investing into mobile home parks?
Obviously, doing your due diligence on the sponsor. Understand, what the return parameters are, what the fees are. I'm all for the sponsor getting paid and paid well, but there has to be an alignment of interests, right? The sponsor shouldn't be made whole just on an acquisition fee, finance fee, construction management fee, I woke up on Thursday fee and what have you. So just making sure that you understand the fees, there's a back end for the sponsor, and then also just hopefully getting some sort of reporting. So you understand, even if a property is not doing great, just being in the loop, right? Hey, not doing a distribution this quarter.
And being consistent
Because
with
of
it,
X,
right?
Y, and Z.
Instead of just, an update this month and then nothing next month and then you're back on it, being consistent and setting expectations, I think, are huge.
I think consistency is the right word, almost throughout the board, right? Whether it's operations, whether it's dealing with, just so everyone has a clear expectation of what's going on.
Totally. Jason, what does the perfect mobile home park look like in your eyes and why?
Oh gosh, I haven't seen it yet. But again, like we touched on briefly earlier, I'd say tenant-owned homes, streets are done. You don't have trees hanging over homes. Ideally, direct build, and collections are good.
And how many lots?
As many as you can buy.
As many as you can get in, right? And you're
Yeah,
buying it at a 10 cap, right?
Exactly. But realistically, there's so many legacy owners still out there that there are great ones. And even the ones that have the deferred maintenance we've touched on earlier, it's understandable because if you're operating this for 30 years or 20 years or however many years from the folks that we've bought in the past, stroking that big check to fix, we spent 60,000 at one property recently just to do the culverts, right? So we had better drainage. That was never going to get done by the prior owner.
Yeah, they're mom and pops, baby boomers. They're, using it as a retirement vehicle. And yeah, it just doesn't make sense. So that's why I think it's good that there's new blood coming into the space that's reinvesting and aligning interests. A lot of people don't get this, but like the nicer the property looks, the better debt you're going to be able to get on it. So it's a win for investors and tenants, right? Like
Definitely.
to make it look nice. Jason, what do you think the future of mobile home park investing looks like with, the direction the economy is going? Obviously, higher interest rates are here. There's possible recession talks still. What do you think that looks like?
We have those conversations often. I still see it as being a great avenue for long-term wealth accumulation, right? You've got tax benefits on the depreciation side. You've got solid cash flow usually. Even, from the more core assets, you can get good cash flow. Debt, my hope is you buy a property a little bit below where it was, a year or two ago. And then you're happy with that purchase price because in 3 to 5 years, you'll be able to refi it, right? And get somewhat more reasonable debt. But you hit the nail on the head. I've had that conversation where certain people have told me, hey, well, I don't know if I'm going to do this next one because I can get 5% in my money market, right? I can get 5% here. I'm taking a risk with you. You've delivered solid returns, but
how do you overcome that? Because I've received that same objection. How do you overcome that at this point? Because now it's like 5.25.
Yeah. So my response was, okay, but look at the last 20 years. Let's say you just left it in your money market. That was 20 years. What would your return have been? Look at those same 20 years in any of the mobile home parks we owned. You would have had your money multiple times over, right? And in addition to that, you'd have the depreciation because a lot of the people that you're dealing with and everyone's dealing with that are investing, they pay a decent amount in taxes. So they could use some of that depreciation to help shelter some of that active income.
Totally. No, good points. What's the biggest threat to mobile home park investing?
We're losing a lot of supply and we're seeing a lot of consolidation, right? Especially, whether it's, mom and pop sells to an operator that buys 20 to 40 communities. That 20 to 40 is then sold to the next bigger fish. Those fish are then sold to the next bigger fish, et cetera. And so we're seeing that. But, again, I still think we're far less consolidated than almost every other real estate asset type.
Totally.
And so I think there's plenty of opportunity.
Totally. Jason, thank you so much, dude. I mean, tons of golden nuggets on here. If listeners would like to get a hold of you, what is the best way for them to do so?
Get me at LinkedIn. Phone numbers on mhcommunities.com or Rochester Property Group. We're always around. If there's questions we can answer, happy to. And again, thank you for your time. Big fan of the podcast.
Yeah, no, real quick before I let you go, what's one last bit of important advice that you would give an interested passive mobile home park investor just before we sign off here?
A lot of people buzz through a PPM because it's got a lot of risks. It's got a lot of other stuff, but just make sure you understand, okay, hey, what's the return I'm going to get? How is the sponsor going to be compensated? And then to me, the biggest one that used to frustrate me is just having that conversation with the sponsor. Hey, what sort of financial reporting am I going to see? I just want an idea of what's going on. We provide basic financial reporting every quarter, along with 3 or 4, I don't want to use the word anecdotes, but updates of larger items that have happened over the quarter. Just so instead of as an investor, you feel like, oh, I'm a partner in this property or in this fund.
Cool. I love it, man. Jason, thank you so much again for coming on the show.
Thank you so much. Appreciate it.
That's it for today, folks. Thank you so much for tuning in.
All right. Take care. Thank you so much for having me on. Really appreciate it.
Hey, are you getting value out of this show? If so, would you mind please going over to iTunes and leaving the show a quick 5-star review? I have a goal of hitting over 100 5-star reviews by the end of 2021, and it would mean the absolute world to me if you could help contribute to that. Thanks ahead of time for making my day with your 5-star review of the show.